Today I'm joined by Diana D'Ambre to talk to us about some of the initiatives that the Australian Shareholders Association, or ASA, is focusing on behalf of its members. Diana, welcome.
Thank you, Christine. It's great to be here today.
As we move into reporting season, what are the issues that the ASA will be focusing on?
We have a number of areas, Christine, that we focus on, but up in this upcoming season, there's probably some key areas that we're keen to look at a bit more closely. They're around board composition, remuneration payments to key executives, and also around the incentives that are paid. On board composition, we try to look at how long the independent directors have been there. We look at tenure, and when, as a guide, if they've been there for more than 10 or 11 years, we'd look carefully at that to see if they're still independent. We like to see a majority of independent directors on the board, and that is fairly consistent with most public companies. On remuneration, we do focus a lot on what the key executives are being paid. As you know, there are some quite exorbitant amounts being paid at the moment to CEOs, and we sometimes find it hard to justify how the boards can really see their way through paying those amounts. But on the incentive side, which is a very important part and a bit opaque for some of the retail shareholders, we like to see the short-term incentives no greater than cash component of less than 50%. So we like to see more equity in there. And on the long-term incentives, we like to see them measured at least over 4 years. This year will be interesting too, because recently the ASX Corporate Governance Council modified their recommendations for public company disclosure. And they'd like to see a director's skills matrix included in the reporting. So that'll be a new addition that we will watch closely and see what type of reporting comes out of that.
Now, Diana, the AGM season will of course follow reporting season. What sort of questions should shareholders ask of company directors?
That's an interesting question, Christine, and shareholders have different views on what they want to hear expressed at meetings. Retail shareholders generally are looking for a company with steady growth and regular dividends. And there's always a balance between the two, depending on the nature of the company. As an important point for most shareholders, clearly if performance has been slipping, they would want to understand what are the directors doing to mitigate that slide in performance, what has altered, what are the risks that have been confronted the organisation, and how are they going to deal with that in the future. Similarly, companies that are performing well should be applauded, and we always do congratulate them because that is a great thing for our shareholder base. Other areas where shareholders are interested in is where there's been adverse comment maybe in the media, and how the companies have dealt with that, what they're doing to improve their commentary that's coming out in the public arena, and we always find that is a good source of questioning. Another area that's of concern to shareholders is when companies have done significant acquisitions. Now, acquisitions in themselves are generally accretive, and hopefully they are, and do add value, but it's always good for the shareholder to understand how the directors got to that decision, how they worked out how much to pay, how that acquisition fits in with the company itself and the other businesses in there, and how it will improve value going forward for the group as a whole. Lately, we've also noticed that shareholders are not just interested in financial performance, but in other issues surrounding how companies deal with corporate social responsibility. And by that I mean, how do companies interact with the environment? What's their view on diversity? How they treat their workforce and suppliers? Because our shareholders are also looking to invest in companies that are doing the right thing by the community generally.
Diana, now on some other issues, what is the ASA doing in overseeing corporate governance?
As you know, Christine, the Australian Shareholders Association stands up for retail shareholders, and we are their voice at general meetings and in the public arena generally. How do we do this? We have about 100 highly skilled, motivated monitors that follow companies throughout the year. During this process, what they do is they analyse company reports, look at press announcements and other public information that's in the arena. Following our research, we meet with the companies themselves. We have access to the directors, the chairman, and often key management. At these meetings, we seek clarification of the company's business practices, management decisions, and strategies going forward. With this information, we then take what we've learned from the company plus our own research and formulate a view as to how we would vote on the resolutions that are coming up to the meetings for the shareholders. And we publish those views on our website so the shareholders can see what we are thinking. We then attend the meetings, ask relevant questions, of the board, and then we've wrote our proxies, which have been given prior to the meeting. For us, it's a very important process. The companies engage with us generally very well, and we are really proud that we can have that access with them. We are their link really for them to the retail shareholder.
Finally, Diana, there's been a lot of discussion about the equity issues around capital raisings, in particular for retail investors. What is the ASA doing on that topic?
That's a really interesting question at the moment, Christine. As you know, we are all about protecting property interests of our shareholders and fairness to all shareholders. We are really concerned about the significant dilution of retail shareholders over the last few years, particularly during the GFC period. Clearly, our favoured form of capital raising is where the retailers can share in a renounceable pro rata entitlement similar to the institutions. Secondary to that, the next best alternative would be an accelerated offer to the institutions, followed by the pro rata retail renounceable entitlement. Now, a good example of that was the recent NAB issue in May, where they raised, I think, about $5.5 billion. And that was done with an accelerated process for the institutions, which was done and dusted in about 48 hours. Then the retail offering followed straight away at the same price. And that was a great outcome, I think, for all shareholders. Another alternative is to do a placement and then a share purchase plan. Share purchase plans, though, are capped under the current rules up to $15,000 per retail investor. But we would like to see no scaling back on those share purchase plans to investors. So therefore, some of those placements may need to be expanded. And we're in favour of expanding those placements to make sure retailers get their fair share of any entitlement, and also to be able to sell those entitlements back into the market. Clearly, where there's a placement at a significant discount, we would not be in favour of those and would not support them. At the end of the day, Christine, it's about fairness to all shareholders.
Diana, thank you so much for your insights today.
Thanks, Christine. It's been great. Thank you.